Hello everyone, welcome to today's US Open live. It is Tuesday, July 18th at our usual time slots, 10 minutes before Wall Street opens. I'm your host Nikos Zabouras, Senior Market Specialist at FXCM. So this week we had another batch of disappointing data from China, and that was in the spotlight. And now focus will be shifting to inflation figures from UK and other regions, as well as the earnings seasons with Netflix and Tesla picking up the baton from the banking sector. Before we get into all of that, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and note that anything discussed here does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. Let's start with Euro USD. The pair posted its best week of the year, boosted by the soft US CPI report in then, and we talked about that last week. Although it is more tame today, it still clinches fresh 2023 highs. Now 1.1495 resistance is in the spotlight, but bulls will likely need fresh impetus to challenge it. On the other hand, the RSI diverges lower, as you can see on the bottom of the chart. So you can see right here how after hitting the most overbought levels in years, it diverges lower than does not follow Euro USD to the new highs. And this can create pressure to 1.1096, although strong catalyst will be required for a breach of the 200 period EMA at around 1.096. And the downside, as we've said before, is well protected. There was some pressure earlier today after the US retail sales, because they dropped to 0.2%, but the control group, which is used in the PCE estimates, rose significantly to 0.6%. Now, markets are generally optimistic about an one and done by the Fed next week, and that is the main driver behind this recent surge. But markets have been disappointed before around a stop by the Fed and rate cuts, which now seems to be their focus. Now let's turn to US oil. Here we are. And let's talk about China's recent data, which of course is the world's biggest importer of oil. So the country continues to offer disappointing data that sustain concerns around the strength of the economy. Yesterday's batch showed the economy grew by a frail 0.8% quarter over quarter in Q2, while the more robust 6.3% year over year was smaller than expected, and also compared to a period that the country was still struggling with the pandemic. So not much of a bit print there, I would say. Now we also had June retail sales, which were definitely disappointing at 3.1%, although industrial production was more a bit, having expanded by 4.4%. Now US oil started the week on the back foot as a result, and now is exposed to the 200-period EMA at around 72.3. Daily close below it would create risk for further declines towards 66.78, but sustained weakness past that level does not look easy. Prospects for further stimulus from Chinese authorities, massive oil supply cuts by OPEC Plus, and hopes for a less aggressive Fed are supportive for the commodity. Above the 200-period EMA, the black line, bias is on the upside, and the commodity can set higher highs, current at 77.31, but does not inspire confidence at this stage for tackling the next resistance at 83.55. And now let's go to the Nasdaq, and we'll talk about the earnings there from the tech sector, the upcoming ones there, and then move with what's ahead, which contains big data points, mostly UK inflation. Now let's focus on the tech-heavy index. So NAS 100 retains its bullish bias and eyes the 16K handle, although the record highs at 16,770 may prove elusive in the near term. The index is subdued today, and the retail sales we talked about are one of the reasons for that. A pullback to 15,301 would be reasonable, but significant deterioration in sentiment would be required for testing the 200-period EMA at around 14.93, where we also have the July lows at around the same region. Now, other than the Fed, which is due next week, the trajectory will also be determined by the tech sector earnings, which kick off with Tesla and Netflix this week. I have already posted video previews of those two companies, which you can find on the FXCM market analysis websites of your respective regions. Tesla has made, let's talk a little bit about that. Tesla has made a series of price cuts since late last year and well into the second quarter to address demand concern, and that has helped it to new delivery records in the second quarter. But now we're gonna see how this affected its profitability and whether it will take another hit. Netflix, on the other hand, has been implementing strategic changes with password sharing crackdown and the ad inclusive subscription plan being the most important, and we'll be waiting to see how these initiatives are coming along and how they impact user metrics and financials. The earnings season, of course, got underway last week with Delta Airlines, which posted record revenues, and big banks with JP Morgan getting a boost to its top and bottom lines. Now, what else is ahead? Inflation figures are in the spotlight. We already had Canada earlier today. CPI, headline CPI is to 2.8% and the lowest in over 2 years. The Bank of Canada had hiked rates by 0.25%. That was a back-to-back increase following June's restart. No explicit guidance, but the bank was concerned that progress towards the 2% target could stall, jeopardizing the return to price stability. So this moderation will definitely be welcome. Now, the main event, though, for me is UK inflation, which is due tomorrow on Wednesday. It has repeatedly surprised to the upside, and the last print had forced the BOE to reaccelerate the pace of tightening with an 0.5% hike. Headline had steadied to 8.7%, but core had jumped to 7.1% in the biggest increase since 1992. So definitely crucial data there because they will affect the BOE. We also get Eurozone inflation figures. Preliminary was for June. Preliminary was 5.5%, lower than in May, and core, however, was 5.4%, a tad higher compared to May. The European Central Bank is not happy with inflation and nor its outlook. And also on Wednesday, we expect the second quarter CPI from New Zealand. Inflation has eased and stood at 6.7% in the first quarter, and that was the lowest level in more than a year. The RBNZ expected to continue to decline from its peak, and along with the fact that there has been an economic slowdown, the country is in a technical recession, policymakers kept rates unchanged earlier this month in a watershed moment after 12 consecutive hikes worth 525 basis points. That's pretty much it from us for today. Thank you for joining me. We will talk again on Thursday, 10 minutes before Wall Street opens.